Let me ask you something. Have you ever taken a trade that looked perfect? Everything lined up, you hit the buy or sell button, and within minutes, the market reversed and stopped you out. And then, almost like that, like it was doing on purpose, the price shoots up in the direction you really originally wanted it to. That was not bad luck. That was not the market being random. That very much could be smart money doing exactly what it was designed to do. The banks, the hedge funds, the biggest institutional players, they do not trade the way retail traders trade. They need liquidity. They need your stop losses. They need you on the wrong side of the trade so they can get on the other side of it. Today, I'm going to show you the first 10 of the 20 most powerful smart money patterns. These are patterns that every trader needs to know. They're the patterns that institutions use over and over again to grab liquidity, trap retail traders, and position themselves before the real move happens. And I promise you, once you start seeing these patterns on the charts, you'll never look at price action the same way again. But here's the thing, I have 20 patterns to share with you, and I'm splitting this into 2 separate videos because I want to go deep into each one. I don't want to rush through these and give you surface level examples. I want you to actually understand why these patterns work so you can spot them in real time. So today, we're covering just the first 10 patterns, 1 through 10. And if you want me to drop part 2 with the remaining 10 patterns, and trust me, these are some of the best, most powerful setups, then type more patterns in the comments below. And if I see enough of you asking for it, I will get part 2 out as fast as I can. So let's get into it. Before we jump into those patterns, let me quickly run through the key terms that you're going to see throughout this video so nothing catches you off guard. S stands for support. R stands for resistance. L is a low. H is a high. LL means lower low. And HH means higher high. These are the basic building blocks of market structure. And if you're watching this video, you probably already know these. But I want to make sure we're speaking the same language. Now, here are the ones that really matter even more. QM. QM stands for Quasimodo, which is the single most important pattern family in institutional price action. QML is the Quasimodo level, which is a specific zone where we look for our entry. LQ means liquidity, and that is what institutions are always hunting for. Without liquidity, they cannot fill their massive orders. On the charts, I'm going to show you red zones represent supply areas where institutions are selling, and green zones represent demand areas where institutions are buying. Blue dashed lines mark key levels like the QML where we are looking for entries. So you got it? Good. Now let's break down these patterns. Pattern number 1 is the QM quick retest, the Quasimodo quick retest. We are starting with the single most important pattern in institutional price action. The Quasimodo quick retest is the one pattern that if you're going to watch this entire video and you take only one away, this should be the one because it is responsible for the more high probability setups than anything else in this video. Here's how it works. In the bearish scenario, price makes a high, pulls back to a low, rallies to a higher high, and then drops to a lower low. That sequence, HL, HH, LL, is the Quasimodo structure. The Quasimodo level sits right at that first high. What we're waiting for is the price to come back and quickly retest the QML zone. When it touches that level and shows rejection, we enter short with our stop just above the higher high. Now, the bullish version of this is the exact mirror. LH, LL, HH, with the QML sitting at the first low. Price retests that level and we go long. The reason why this works is because that QML represents where institutionals originally placed their orders. When price returns to that zone, they are defending their position. So you're essentially entering at the same level as the big players. Pattern 2 is the QM late retest. Same exact Quasimodo structure as the pattern 1, with one very important difference. This time, price does not come back to the QML level quickly. It takes its time. It might swing up and down and then consolidate, chop around for hours or even days before it finally returns to that level. A lot of traders make the mistake of thinking that if the QM level does not get retested quickly, then that level is dead, and that is wrong. A late retest often catches more traders off guard because they have forgotten about the level entirely. The institutions, on the other hand, have not forgotten them at all. They still have orders sitting there, and they still defend that zone when price returns. The one adjustment you might need to make with a late retest is giving yourself a slightly wider stop loss because more time has passed and more price action has developed around that zone. and this reaction might not be as clean as a quick retest, but the logic behind the pattern is identical. Pattern 3 is the QM shadow. This is where things start to get really interesting because a QM shadow is a variation that catches even experienced traders off guard. The Quasimodo structure forms just like it does normally, but when price comes back to retest the QML, it does not touch the level and bounce. Instead, it pierces right through the QML with a long shadow or a wick. It sweeps the liquidity just beyond that level, takes out all the stop losses of traders who are already positioned at the QML, and then snaps back aggressively. Now, most traders will see that wick and they start to panic. They think the level has broken. But what actually happens is that institutions just grabbed the extra liquidity they needed to fill those orders. The shadow is not a sign of weakness. It's actually a sign of strength. Your entry on the QM shadow comes on the rejection candle after the wick. And here's the beautiful part. Because the shadow gave you a deeper entry point, your stop losses goes beyond the tip of that wick, which often gives you an even tighter and even better risk to reward ratio than a standard QM retest. Pattern 4 is the QM re-entry. This is one of my absolute favorites because it gives you sniper level precision on your entries. Here's what happens. You have a large Quasimodo pattern forming on your chart. You have your main QM level identified, but instead of entering at the main QML, you drop down to a lower time frame and you look for a smaller QM structure forming at that main Quasimodo level QML zone. And when you find it, you now have a small QML nested into a main QML. Think of it like a zooming in on a magnifying glass. The large QM tells you the direction of the zone. The small QM tells you exact price to entry. The advantage here is massive. Your stop loss goes beyond the small QML structure, not the main one. So you're getting positioned for the large move, but with the fraction of the risk. So when these nest perfectly, you can get entries with 2 to 1, 3 to 1, sometimes even 5 to 1 risk reward to risk before price even reaches the first target. Pattern number 5 is the continuation QM. Now, patterns 1 through 4 are all reversal setups. The continuation QM is different because you're not looking for price to change direction. You're looking to enter a trade in the direction of the existing trend. In a bullish uptrend, you want to see the price form a QML at a low level. Price then pulls back to the QML and then continues higher, making new higher highs. In a bearish downtrend, the QML forms at a high level and the price rallies to it before continuing lower. What makes this pattern so powerful is that you have the trend on your side, and you know I love that. You're not trying to catch a reversal, which is inherently riskier. You're trying to trade with the flow of institutional smart money. The QML gives you the precise entry point for what is essentially a pullback trade with the structure and logic of smart money behind it. I use continuation QMs constantly in trending markets. When gold and the indices are in a clear trend, these setups show up everywhere and they have a very high win rate because you're trading with the momentum, with the trend, not against it. If you like these patterns, check the links in the description for the brokers and the prop firms that we trust and where you can start applying these patterns in real markets right away. You can also get the best discounts with the prop firms using our codes in the description. Now, pattern number 6 is the ignored QM. This one requires patience, but when it triggers, the reaction can be explosive. An ignored QM is a Quasimodo level that was never retested. Price forms the QM structure, created QML, and then just kept going without looking back. That level was ignored. Now, here's what makes most traders get wrong. They see an untested level and they slap a limit order on it and walk away. Do not do that. Just because the level exists does not mean price will respect it when it eventually returns. What you want to wait for, and what you need to wait for, is a fake out through the ignored level. When price finally returns to that zone, it will often pierce through it first, grabbing the liquidity from traders who were front running that level. That fake out is your signal. Once price pierces through and then snaps back, you have the confirmation that institutions are defending that zone and you can enter with confidence. The reactions off ignored QM levels tend to be violent because all that pent-up institutional interest that was never expressed gets released at once. It's like a coiled spring that's been compressed for a long time and finally lets go. Pattern number 7 is the 2R2S fake out. Remember, R is resistance, S is support. Now we move into the fake out family, and this is where you really start to understand how institutions manipulate retail traders. The 2R2S fake out is beautifully simple. Price forms a double top with 2 resistance touches, or double bottom with 2 support touches. Every trader on the planet is watching that level. The breakout traders, they are waiting above resistance with their buy orders. The reversal traders are sitting at the resistance with their sell orders, and the stops just above. Institutions know exactly where all of these orders are. They have their order books. So what do? They push price through the level, all the breakout traders get filled, and all the stops and reversal traders get triggered, and that wave of order creates the liquidity that they need and want. And then once all these orders are filled, price reverses hard. Your entry is not on the breakout. Your entry is on the reversal after the fake out. You want to wait for price to push through the double level, and then you want to wait for it to come back through. That confirmation is then your signal. Stop goes just above the fake out pattern, and that's what you want to see. Pattern 8 is the V-twin. The V-twin is a pattern that screams institutional demand or supply, louder than almost anything on a chart. What you're looking for is a 2-sharp V-shaped reversal at approximately the same price level. Think of it like price is slamming into a wall, bouncing off, coming back and slamming again into that exact same wall. 2 violent reactions at the same zone tells you that there's serious institutional level interest sitting there, and that is obviously a very important level. The first V establishes the zone. The second V confirms it. Your entry comes on the second V rejection. Your stop goes below the V-twin lows for a bullish setup or above the V-twin highs for a bearish one. I see the V-twins form a lot around key session levels like the London Open, New York Open, and around major event levels. When institutions are defending a price zone aggressively enough to create 2 V-shaped reactions, you want to be trading with them, not against them. Pattern number 9 is the fake out V1. This is the most common fake out structure you will see, and probably the one that has caused the most pain if you've ever tried to trade a breakout. Price, in this case, establishes a clear resistance at R1 and R2, or a clear support at S1 and S2. Multiple touches confirm that that level is important. Then price makes a move that pushes through that level briefly before snapping back. The key word is briefly. If the price pushes through and closes strongly beyond that level with momentum and volume, that could be a legitimate breakout. But if price spikes through and immediately gets rejected, if you see a long wick, a quick reversal candle, or a fast snapback, that is your fake out. Now, what I want you to do after watching this video is go back through your own charts and find every time you got stopped out on a breakout trade and see if you see this fake out V1 pattern, because I almost guarantee you that there was quite a few examples of that happening. Price broke through, you jumped in, and then it reversed on you. Now that you know what to look for, hopefully you can be the right side of those moves and not be faked out. Pattern 10 is a stop hunt into supply. I saved one of the most important patterns for last in this first half, because once you understand stop hunts, everything else starts to make sense. Here's the setup that you want to look for. Multiple resistance levels form, like RRR. Retail traders see all that resistance and they go short. They're selling at the resistance with their stop losses sitting just above those highs. That cluster of stop losses is like a magnet for institutional money. Institutions, they push price up into that zone, not because they want to buy. They push it into to trigger all of those buy stop orders. And it happens a lot around market opens. Those triggered stops create a flood of buying volume. And that volume is exactly what the institutions need to fill their massive sell orders. They're literally using your stop losses as their entry levels. And once they're filled, there's no more buying pressure left because all the stops have been triggered and all the breakout buyers are now in. And then the price drops. It drops hard. Your trade is on the reversal. You want to wait for price to spike above the resistance, engulf the previous high, show that's rejected, and then enter short. Your stop goes above that stop hunt spike. The beautiful thing about stop hunt entries is that the risk to reward is often excellent because the stop hunt extremes mark the absolute top or bottom of the move. All right, these are the first 10 to 20 most powerful smart money patterns that I wanted to share with you. And I need to be real with you. We're just getting started here. The patterns that I covered today are foundational. They are the setups that you're going to see every single day on your charts. They're the most common setups. But if you want to learn the next 10 patterns, you know what to do. Type more patterns in the comments below. I'm talking about patterns like the diamond fake out, which combines QM with SR flip for the maximum confidence. The SR RS flips that every institutional traders use to confirm structure shifts, the flag B pattern, which is one of the cleanest entry setups I have ever seen. So these are the setups that, I'll share with you in part 2 if you're interested in learning more about them. So make sure you type in more patterns into the comments below. These 10 patterns that you've learned, I want you to go in your charts. I want you to look for them, and I want you to look at them as another layer of precision and confluence on top of what you're doing already. And if you want me to drop part 2, go in the comments, type in more patterns, and that's it. And, if more of you ask for it, I'll get to that video out as soon as possible. I also, while you're there, I want to hear from you what your favorite pattern that you learned today was, or what was completely brand new to you. I read every single one of your comments, and I love hearing what clicks for you. Now, let me leave you with a few quick principles that I hope will help you actually use these patterns in your live trading. Number 1, always look for multiple time frame confluence. A QM on the 4-hour with a fake out on the 1 hour is significantly more reliable than a single time frame signal. Use the higher time frame for direction than lower time frame for precision. Number 2, never enter in just one pattern identification alone. Just because you see a QM structure does not mean that you take the trade immediately. You want to wait for a retest, wait for the rejection candle, wait for the confirmation. Patience at the entry is what separates profitable traders from everyone else. Number 3, risk management first, always. Use the pattern structure to place your stops at logical invalidation points. If the higher high gets taken out on a bearish QM, that pattern's dead. Accept the stop loss and move on. Never move your stop and never hope. And number 4, focus on quality over quantity every time. These 2 patterns do not appear on every candle. One perfectly executed smart money trade per day is enough to beat 10 random entries every single week. So wait for those setups that make sense, that make you say, yeah, this is the one. All right, if you got value from this video, smash that like button. It takes 1 second and it generally helps the channel reach more traders who need to see this. Subscribe if you haven't done so already, because part 2 is coming and you do not want to miss it. And remember, check the links in the description for the brokers and prop firms we trust and where you can start applying these patterns in real markets right away. I'll see you there. Trade smart, manage your risk, and follow the smart money.